Forget everything you think you know about accounting. You know, the dimly lit room, the frantic clicking of calculators, the yearly stress of tax season.
Hmm.
We're making a pretty bold argument today. We're saying that if one critical thing just vanishes overnight,
Right.
not every novel, not every scientific textbook, but every single ledger and bookkeeping record modern society as you know it, well, it collapses.
And that assumption that accounting is just, fundamentally dull or purely technical is exactly what we have to challenge today.
Okay.
If you believe that large-scale credit or global trade or even just reliable public services are possible without this system, then I think you fundamentally misunderstand the very bones of how our economic world is held together.
So our mission for this deep dive is to explore what is arguably the most invisible yet most critical framework of modern trust.
Exactly.
Accounting isn't some side task. It's the essential information processing system that underpins, well, everything, all of modern order.
We're going to frame accounting as an evolutionary system, an intelligence system, really. And the central argument we've pulled from the sources is pretty clear and stark.
It is.
Society simply cannot function at any significant scale without a common, trusted, and verifiable system to record who owns what and who owes whom. It's that basic.
So we're answering an almost existential question: what is accounting, and why does its existence maybe even precede civilization itself?
A great way to start is by looking at the ultimate stakes.
The sources lay out this really shocking hierarchy of societal loss, and it forces you to reconsider what we truly need for daily functioning.
Yeah, it's like a ladder of a disaster. So first, imagine losing all of our cultural assets.
Every poem, every film, every novel ever written, gone.
Right. And that is an irreplaceable cultural loss, of course.
Yeah.
A tragedy. But daily life, the logistics of production and exchange,
Machinery of society.
it proceeds. We all still know what our rent is. The trucks still run.
Okay, so let's move up the scale. What if we lose all the professors and all the institutional knowledge they hold?
That's a massive intellectual setback. I mean, you're talking years of delay in scientific progress. But commerce still grinds on. Factories are still producing goods based on the orders they already have.
But then we get to the top of that ladder.
And this is the key. The moment you lose all bookkeeping records, the collective verified memory of all our transactions, you trigger a genuine catastrophic systemic collapse.
So the verification mechanisms that allow for any non-barter economy where I trust you'll pay me later.
They just evaporate overnight.
When you say catastrophic collapse, can you ground that for us? What does that actually look like? How does the system fail when the ledgers disappear?
It's the collapse of credit. Modern life is built on promises. It's built on deferred payment.
Okay.
Banks only lend you money because they can verify your past performance.
Right.
Companies only ship goods because they can verify a client's payment history.
So if every record just disappears?
Then every single institution, banks, governments, businesses, they all become insolvent until they can somehow independently verify their assets and their obligations, which is impossible.
Wow. So without those records, I can't prove the bank owes me the money in my checking account.
And the bank can't prove you owe them for your mortgage.
Everyone has to start from zero, relying only on personal memory and, I guess, guesswork.
Exactly. And when you remove that objective infrastructure of trust, complex commerce, which relies on interacting with strangers over distance and time, it just collapses. It goes back to a primitive state.
Because that shared record is what answers the most fundamental questions of any exchange.
It answers three foundational questions. First, who owes what to whom? And that covers everything from your personal credit card balance all the way up to international government debt.
Okay, what's the second?
What happened? I mean, that's the verifiable log of a past event.
Yeah.
The receipt, the shipping manifest, the attendance record.
And the third, which sounds crucial.
What proof do we have? Bookkeeping is the technology that replaces our, very unreliable personal memory with objective, shared, and verifiable evidence. And that ability to verify is non-negotiable for society to scale.
That makes perfect sense. So if the record itself is the ultimate foundation, is just having the record enough, do we just need people who can meticulously log every transaction? Or is there another layer?
And that takes us to the crucial distinction between two very related but very different concepts.
Bookkeeping and accounting.
Exactly. And we can separate them pretty easily using the what and the why.
Okay, let's start with bookkeeping, the what.
This is the disciplined, systematic, even mechanical recording of financial data. The entire focus here is on accuracy, completeness, and consistency.
So it's the raw data, The reliable historical memory.
The sources use a great analogy. Bookkeeping is the scribe in a medieval monastery. That scribe's job is pure fidelity. They just meticulously copy the text, letter by letter, without error. They're just trying to preserve the original message.
Yeah.
They're recording events, not analyzing their meaning.
And then you have accounting, the why.
Right. And this shifts the focus entirely. It's the purposeful analysis, the summarization, and the interpretation of all that data. It uses the reliable record that the bookkeeper created to support evaluation and decision-making.
So the accountant is the scholar.
The accountant is the scholar, yes. The scholar takes the text that the scribe copied, organizes them by theme, analyzes what they say, and maybe writes a history based on those revelations.
Or even predicts future trends.
Exactly. It moves you from just raw data to actionable intelligence.
And the relationship is mandatory. You can't have one without the other. Well, you can't have the analysis without the record first.
You can't. You cannot build the cathedral of accounting intelligence without the bedrock of bookkeeping.
Let's use an example. The sources mention a phone call log.
A simple operational example. So your company's phone log, that's the bookkeeping, it tells you that your salesperson called a client in Tokyo.
Okay.
And the call lasted exactly 47 minutes and cost, say, $12. That is the accurate raw data. That's the what.
But the accounting analysis goes deeper. It takes that raw cost, compares it to the revenue that client brings in.
Right, the lifetime revenue.
And maybe it incorporates the salesperson's commission, and then it tells you if that call was actually profitable and by how much.
And then it uses that insight to inform a future strategic decision.
Yeah.
Should we adjust our international calling plan? Should we change the commission structure to incentivize shorter calls? That's the why.
So accounting structures the data to give it context, to guide future choices.
Precisely.
What's truly fascinating here to me is that this drive to count and track and account, it's not some modern invention from, I don't know, the Industrial Revolution.
No, not at all. It's primal.
We're talking about a system that predates even written language, which is just a mind-bending historical fact.
It's profound. I mean, archaeologists have found 7,000-year-old clay tokens.
Wow.
And these tokens served as early bookkeeping records. They were used to track livestock and grain stores in ancient Mesopotamia.
So the need to record economic reality was one of the primary drivers for civilization itself.
It suggests accounting isn't a byproduct of complex society. It's an essential prerequisite for it.
And the really remarkable thing is that the questions that ancient farmer was asking about his sheep and his grain.
They're the exact same questions a modern CFO is asking about a billion-dollar supply chain. They are timeless.
So the ancient farmer asked, what do I have right now?
That's the modern balance sheet, a snapshot of your assets and liabilities at a specific moment in time.
How has it changed over the last season?
That's your modern income statement or a performance report. It's like a video showing revenue and expenses over a period.
And maybe most critically, is it enough? Is it enough to survive the winter and plant for the next season?
That is forecasting and decision-making. This is where the analysis turns into action.
And that decision-making element is where the stakes get incredibly high. I mean, we can apply this directly to one of the biggest entrepreneurial risks in modern history, Ray Kroc buying out the McDonald brothers.
Absolutely. Kroc was faced with this massive strategic choice. He had to borrow $2.7 million.
An astronomical sum in the 1960s.
At a crippling 50% interest rate, just to get control of the franchise.
That's an insane cost of capital. You can't make a decision like that on a gut feeling. He had to use the accounting framework to answer that ancient question. Is this enough?
He had to. He had to look at his balance sheet to see his current capacity and, more importantly, he had to use accounting principles to aggressively forecast his future income statement.
He needed proof.
The accounting had to prove that the potential increase in revenue from controlling the whole operation would far outweigh that colossal interest payment. It was a projection, but a projection based on structured historical data. That's the power of it, turning past activity into justified future risk.
Let's bring this right down to the listener's personal life to make it really clear. Let's say you're just tracking your checking account.
Okay. The routine of logging a transaction, Jan 15 payment to ABC Apartments, $1,200, that's the bookkeeping step.
You're just focused on mechanical accuracy. Did I get the amount and the date right?
Exactly. But the accounting kicks in when you stop just recording and you start analyzing.
So that's when you categorize that $1,200 as rent. You combine it with utilities and insurance, You look at your overall income and then you realize,
You realize your housing costs are now 40% of your take-home pay, and that's up from 35% last year.
the accounting insight is the conclusion. That trend, which the structured data reveals, is unsustainable if you want to meet your future goals, like saving for retirement.
And the decision is the action you have to take. Move, ask for a raise, cut other spending. The bookkeeping is the memory of the past. The accounting structures that memory to guide your future.
So to bring this all together, let's move from these examples to the formal, definitive definition of accounting. It's actually incredibly pragmatic.
Formally, accounting is defined as a system that provides quantitative, primarily financial information about an economic entity, structured to be useful for making economic decisions about the future.
Okay, that definition reveals four essential pillars that kind of govern the whole practice.
It does.
Let's dissect them. Pillar one, it has to be quantitative and financial.
This means it deals with numbers and money. That's the universal language for allocating resources. Its strength is precision, but it does have a limitation.
Which is?
It can only capture things that can be reliably measured in monetary terms. It misses, the softer, non-financial factors like employee morale or brand loyalty.
Okay. Pillar two, it must be useful.
This one is vital. This defines the whole system's value. Its utility is its only judge. If an accounting report is perfectly accurate but doesn't actually help a decision-maker act.
Whether that's an investor or internal management.
Right. If it doesn't help them, it's functionally irrelevant. Utility is everything.
That raises a question, though. If the goal is utility, and it also has to be decision-focused, that's pillar three, doesn't that make the whole system subjective? Can't you just structure the data to support the decision you already want to make?
That is a critical point. The data itself, the bookkeeping part, has to remain objective, accurate, and verifiable. That's non-negotiable. But the structuring is purposeful.
Okay.
The decision-focused pillar just means the data is organized to answer a specific forward-looking question. Should we expand? Should we borrow? Should we merge? The whole point is to inform future choices, unlike, say, history, which just summarizes the past.
So the purpose is looking forward, but the content must be anchored in the past. Which brings us to the final pillar. It's a structured analysis of past data.
Yes. It takes the raw, sequential history, all those chaotic ledger entries from bookkeeping, and it transforms them. It categorizes, summarizes, and applies rules to reveal patterns and relationships that were not obvious in the raw data. It's the bridge from recorded history to usable intelligence.
That synthesis brings us right back to the dual function of this economic engine and that mandatory sequence we talked about.
It is. Bookkeeping is the recording function. Its primary command is just. Get it written down accurately and consistently.
Its purpose is to create that reliable, verifiable memory. And without it, you have chaos.
And accounting is the analysis and decision support framework. Its command is structure that memory to analyze, forecast, and decide. Its purpose is to evaluate performance and guide future action.
And without that layer, you just have tons of data but zero insight.
And the flow is immutable, whether you're Ray Kroc at buying out the McDonald brothers or you're just deciding on a vacation budget. Bookkeeping, the record, provides the data. Accounting, the structure and analysis, generates the insight.
And the result is the informed decision, the act, that determines your future.
Exactly.
So what does this all mean for you? Well, next time the term accounting comes up, remember, you're talking about so much more than just counting beans. You were talking about the essential information processing system that allowed human society to move beyond localized barter economies into a world of complex credit and really global cooperation.
The scale of impact is truly impressive when you think about it. This is the system that allowed that Mesopotamian farmer to decide how much seed grain to risk on a new field.
It's what allowed Ray Kroc to make $1 billion bet based on a high-stakes calculation of future cash flow.
And it is the exact same framework that allows you, the listener, to determine with predictable confidence if you can afford to start a new business or save up enough for that mortgage down payment.
Accounting exists to turn the chaos of random, unverified transactions into a coherent, structured story that guides intelligent action.
Bookkeeping remembers the past. Accounting uses that memory to plan the future.